Right, so this is going to be a very short video. I've got a lot of buying to do. Like, it's Black Friday, okay? Black Friday sales is now on. However, before we dive into it, I want to quickly share a segment from The Psychology of Money by Morgan Housel. I highly recommend you guys read it if you haven't already, especially in a market like right now, where we're seeing high growth stocks completely get destroyed, whilst the market and the indices are setting new all-time highs or trading near all-time highs. I mean, many small to mid-cap, even large-cap growth stocks are now trading at or near their 52-week lows. So you really need to get this book. I think it's a fantastic book to really understand the psychology of money, especially the psychology of this market. Now, let's look at what he says here, okay? Hold stocks for the long run. You'll hear it's good advice. But do you know how hard it is to maintain a long-term outlook when stocks are collapsing? Which stocks are doing right now? We've got great companies, quality businesses with great long-term potential and also growth prospects tanking right now. Like I said, they're at their 52-week lows. Do you know how hard it is to maintain a long-term outlook when stocks are collapsing? I'm seeing it in my Discord as well. I'm seeing it on YouTube. I'm seeing it on Twitter. Like, people are at a stage now where they are foregoing all of their research, if they did any research. Let's just assume they did their research, but all of their research, all of their due diligence, they're just throwing it out of the window. They're panicking and they're getting scared because the stocks are collapsing. However, like everything else worthwhile, successful investing demands a price, okay? Successful investing demands a price, but its currency is not dollars and cents. It's volatility, fear, doubt, uncertainty, and regrets, okay? A lot of people are feeling this regret right now, okay? But this is the price you pay for successful investing: volatility, fear, doubt, uncertainty, and regrets, all of which are easy to overlook until you're dealing with them in real time. And this is exactly what we're dealing with right now. I mean, you've heard people say there's so much FUD in the market. That's fear, uncertainty, and doubt. But what we're experiencing right now, in conjunction with FUD, is huge amounts of volatility. And this is the price, okay? The inability to recognize that investing has a price can tempt us to try to get something for nothing. Now, let's be real. A lot of people that started investing last year, especially if you started investing after the crash in March, you pretty much got something for nothing, okay? You've not really experienced volatility like you have this year, you know, and that's the problem. That's the biggest problem facing a lot of retail investors who started last year. You've not been through periods of volatility, and this year has been incredibly volatile, and it's been volatile predominantly towards the downside, okay? So this is the price you have to pay, okay? And he says the inability to recognize that investing has a price can tempt us to try to get something for nothing, which, like shoplifting, rarely ends well, okay? And you're seeing a lot of retail investors now just giving up. Like, it's just been a year. I've just been buying the dips. That's the comment I received quite recently. You know, I'm fed up of buying the dips. I've been buying the dips all year. I'm done, you know, and they're cutting their losses. So it hasn't really ended well for those people who are forsaking all of their research, forsaking the investment market, the stock market, and just giving up, okay? Next, it sounds trivial, but thinking of market volatility as a fee rather than a fine is an important part of developing the kind of mindset that lets you stick around long enough for investing gains to work in your favor. Facts. And I tweeted this earlier. I said volatility is the price we pay for stock picking, okay? If you can't handle volatility, put your money in an ETF and pay their fees. Either way, you're paying a price to be in the markets. The markets is not free. Whichever way you want to go around it, if you can't endure the volatility, then stick it in an ETF, a diverse, broad ETF that tracks the S&P 500. You do very well. Warren Buffett has said it many times that he believes 90%, 95% of investors should just put their money in an ETF. Why? Because of the price. It's because of the price that's required for stock picking, okay? So if you start by thinking of market volatility as a fee rather than a fine, it's an important part of developing the kind of mindset that lets you stick around long enough for investing gains to work in your favor. Like I said, volatility is the price we have to pay. If you can't handle it, then probably the markets is not for you, okay? And John Templeton, I've been really on John Templeton over the past week. He says to buy when others are despondently selling and sell when others are greedily buying requires the greatest fortitude and pays the greatest reward, okay? Opendoor. This stock has absolutely collapsed, okay? It has been discounted to the moon. Well, not to the moon, it's gone the other way, but this is insane. Guys, this is absolutely unbelievable. My average previously was $19, but I have been buying ever since we dropped past that, and I've got my average to about $18.78. I can't believe that I'm in this position. I'm able to own more of this company for cheaper. It's a steal. Now, let me show you some of the reasons why I continue to buy into this volatility and this fear, okay? We had some information regarding the housing market that came out yesterday. So the existing home sales data came out, okay? And Redfin pretty much compiled all the information. And this is where we're at, okay? This is where the market is currently at. We have a real estate market right now where the housing supply has been going in one direction, okay? It's been trending downwards. So you have a situation where supply is getting less and less, okay? There's less and less supply with each existing home sales report coming out, okay? Now let's take a look at the demand side, all right? You have a situation where demand is high, okay? So demand for houses over the past 3 years has been trending upwards, okay? So you have supply going down and demand going up. And if you know anything about economics, okay, when demand exceeds supply, there's only one thing that's going to happen, and that's what happened right there. Home sales rose in October as investors rushed into the market. We're starting to see the price of homes uptick once again, okay? But let's take a look at this. Even though we've seen an uptick in the most recent reports, the housing market is still cooled off, okay? In comparison to where it was earlier in the year, the market is still cooled off. But relief for home buyers was short-lived. And now let's take a look at the United States home sales data charts. Okay, you can see this was where the market was at its all-time highs. You see what I'm saying? So this was where, around this period here, was where Zillow was going crazy and overpaying for house prices. Meanwhile, Opendoor and OfferPad, they started to cool off. And at this point here is pretty much where Zillow offers capitulated. They threw in the towel and they couldn't continue. However, Opendoor and OfferPad continued to grow, okay? Let's take a look at their revenue. You can see with Opendoor's revenue, even though the house sales prices started going down, okay, the market started to pull back and cool off, Opendoor's revenue continued going up exponentially quarter after quarter. As well as that, you saw our gross profits also trending upwards alongside our operating income trending in the right direction, okay? So where Zillow capitulated with iBuying, Opendoor thrived, okay? And now we have a situation where, guess what? New home sales are starting to tick back up again because you have less supply and more demand, okay? So this is going to be huge for Opendoor going into the next quarter and many more quarters afterwards, all right? And the markets are just completely not factoring this in. And I think if this trend continues that we're seeing, so we've seen that inflection to the upside, if that continues, or if we maintain this level, that's going to be absolutely incredible for Opendoor and also our top and bottom line. And the markets are just completely ignoring this, okay? So here are some third quarter highlights. Our revenue was $2.3 billion, which was up 91% versus Q2. Again, sequentially, it was up 91%. Again, you're seeing many companies year over year, they're reporting 30%, 20% growth. Opendoor was up 91% sequentially. That's exponential growth, okay? Gross profit was also up. We reported a gross profit of $202 million versus $159 million in Q2. Now, this is where a lot of people have some qualms, okay? Gross margin reduced. So the gross margin of 8.9% versus 13.4%. Again, the reason why the gross margins declined was, let me take you back. We saw a little bit of a decline here, okay? But even management commented on it during the Q3 earnings call. It says in Q1 and Q2, our margins outperformed these levels for two primary reasons. As we exited 2020 with very low inventory, our resale mix was heavily over-indexed to recently acquired homes. And two, we were deliberately a bit conservative and how much HPA, which is home price appreciation, we embedded into our pricing into the early part of the year, particularly as HPA accelerated throughout Q1, okay? So again, this is why we saw the gross margins were quite high in Q2 and in Q1, management were being conservative, but as the market started to pull back, which we saw, margins were affected, but we still eked out a gross profit. But now we're starting to see the markets pick up again because of supply versus demand. Net income, or should I say net loss, was 57 million versus 144 million in Q2. Again, everything is going in one direction, which is upwards, okay? Grew our inventory balance to 17,164 homes. So as well as an incredible quarter, they raised their guidance. They raised the Q4 revenue guidance to be between 3.1 billion and 3.2 billion. So combined for full year 2021, management are expecting about $7 billion, okay, in top line. But look at our market cap. Our market cap as of today is at $10 billion. So I think we actually ticked lower. I think I was able to pick up some more shares of Opendoor when the market cap was below 10 billion, which is just an absolute steal. So essentially the value of the company, which is crazy, right? The market cap is about to level up with how much money the company is about to generate this full year 2021, which is insane. And if you look at analyst expectations going forward, okay, the analysts that are covering Opendoor, look at their expectations for sales growth next year, 100%. That's the expectations going into 2022, 100% year over year growth. Madness. I bought this weakness. This is absolutely irrational. This makes no sense. And thank you so much for selling your shares. That's all I can say. Thank you so much for selling your shares. I got my average down below $19 again. And if this continues, hopefully, if we see $13, okay, if we test our all-time lows, oh my goodness, I'm doubling my position. Oh, can I double my position? Oh, it's going to be so tempting. But yeah, anyway, so thank you so much for watching. I just wanted to quickly put on this video and just put it out there. Yeah, just to let you guys know what I'm doing. Thanks so much for watching. I'll catch you next one. Peace.